Hey guys, we are back again. My gosh, our market forecast never continues. Here we are, June 2023, real estate market snapshot, and we will jump right in. I have way too much stuff. We've been trying to keep these videos to somewhere around 20, 25 minutes. That's going to be tough for me today, so let's just jump in and see what we've got. So again, for those of you that are new to the show, I'm Lance Martin with Coldwell Banker Town & Country, and I will be your host for the next half hour or so. We still have everything. We're still using the exact same QR code that we used for the market forecast that we did back in March. So all of that content is there if you missed it, and all of the slides and all of the decks and everything that we're doing and the prior snapshots, you can all find through this QR code. There's a million other places for you to find them, but that QR code will get them there for you as well. So we're going to start with what's in the news. Some of these things are real kind of minor, but I figured what the heck, we'll take a minute and talk about them. If you've been paying attention over the last week, State Farm, Allstate, and I think maybe one others, has decided to leave the California insurance market. Why do I bring that up? And we could get into a political conversation, which I won't, but it's basically not good for residential real estate. Whatever the reasons are, whether they're concerned about, fires, or whether they're concerned about the cost to rebuild, and apparently there's some new regulations from the insurance commissioner that talk about rates and what they can increase and what they can increase. But when you have names like State Farm and Allstate leaving the California residential housing insurance market, I don't know. That doesn't feel good to me. So we'll see what happens with that. I want to start off today's video talking a little bit about this chart. It's a little grainy, so again, for those of you that are really chart geeks, when you're done watching the video, go to that QR code. You'll be able to pull this chart up on your own and take a peek at it. So what we're looking at here, I saw this. This came across the Twitter feed probably about 2 weeks ago, and I instantly said, wow. It really ties into what we've been talking about here for the last year and a half. And what you are looking at are basically loan originations, okay? And this goes all the way, this is 20 years old. This goes all the way back to 2021, 2022. So we got about 20 years of loan originations. Now the chart, if you guys are really geeks and you want to go back and take a look at this offline, you're going to notice it says, wait a minute, Lance, this is loan originations by credit score. Okay, sure. That's not really what got my attention here. So for example, the green bars are super great FICOs of 760, and the orangish bars are not so great FICOs of 620. So I think the point they were trying to make with this is the number of loans generated based upon your credit. Okay, fine. That's not what got my attention on this. What got my attention is the number of loans generated, let's call this 2004, and the number of loans generated in basically now, okay? Now, a couple of factors on this. So for those of you that are instantly screaming out, wait a minute, Lance, there's no refi business. Okay, fine. We got to take the refi business out. But even after you take out the refi business, frankly, the number of transactions that are being done, and this is in the United States, by the way, this is the entire country, is just significantly lower. Now, if you happen to be in the loan business, then you're going to take a look at the entire chart and say, well, yeah, Lance, I realize that. The refis are gone because interest rates are now in the mid to high sixes, and the purchases on the transaction volume is down. So I just found it really, really striking, just as far as where we are from a pure volume standpoint. And we'll talk a little bit more about that later. For those of you that want to dig into the credit side of this, the point that the chart was trying to make, quite honestly, or the person who pushed the chart out, and by the way, the source on this is Bianco Research. I'm not really sure who they're out of. Oh, excuse me, New York Federal Reserve. Reposted by Bianco Research. So this is from the New York Fed. And every time I do that, all the sources on these charts are all sourced, so you guys can take a look at those as well. But the point they were trying to make is the loans that are being done now are so much higher quality loans that were being done before. And again, when you see a lot of green, even these reds up here, those reds, that's a 620 FICO. It's not the best FICO score in the world, but you got a 620 FICO, you're buying a house, okay? So, excuse me, the reds are actually 660, that bluish bar, which is very, very small up here. So it looks like the majority of the loans are people with 660 FICO or above. And quite honestly, those of you that have a 780 or 800 FICO, don't laugh at the folks with 660. If you have a 660 FICO score, you're getting a loan today, and you're getting a pretty decent loan. So, and frankly, I would say probably even down into the low sixes, you're still getting a loan. So if you fall into that category. But the point I was making is just transaction volume. Another chart that I pulled up, this was republished by Fortune magazine. They pulled it from Zillow, and then again, it was reposted by a gentleman by the name of Lance Lambert, no relation, on Twitter. Lance has got some really cool stuff out there, so you might want to follow him as well. But I thought this was interesting for a couple of reasons. There is a lot of discussion about property values and real estate collapsing and the world's ending and all the rest of that. We've been talking about this for over a year, and I've been telling you for over a year, calm down, everything is fine. Yes, we've seen some property values collapse, but collapse, goodness gracious. We've seen some property values pull back a little bit. I used the word on my interview with Chris Thornburg last month. I said, price destruction, and he immediately, like, destruction, and I said, yeah, geez, here I am. I'm contributing to the problem. I'm using dramatic hyperbole to describe the market, and when you say price destruction, especially coming from someone like me, like, oh my God, Lance must think the world's ending. So I posted that video as is. I didn't edit it out, but we're not seeing that, okay? And for those of you that are concerned about that, this chart, along with the rest of the stuff I'm going to share with you today, I think will probably put you at ease. There's some other things to be concerned about, but this in theory will put you at ease. So what are we looking at here? This is basically from Zillow, republished by Lance and put in Fortune magazine. And this was like 2 weeks ago. So what are we looking at here? Basically what you're seeing is remaining pandemic housing boom gains. So what they're talking about is prices across the country from March 2020, so we'll call that start of pandemic, up until last month, April of 2023. And in effect, without even knowing what the colors mean, every single color on this map of the United States represents property values that have increased from March of 2020, okay? So let's just take a look at a few of them real quick, and I know it's hard to see, so you can see this on the PowerPoint. The darker the color, so the deeper the color, those represent 60% increases from March of 2020 from where they were for where they are today. Let's just come down to our little marketplace right here. So for those of us that are, oh my gosh, Southern California has been struggling and we've started to see the pullback in values and all the rest of that. Well, we're kind of this, I don't know what color that is, kind of orangish red, which still represents on the low side a 20% increase, on the high side a 30-40% increase in property values. Very, very true. So yes, we've seen a little bit of pullback, which, by the way, we've retrenched a lot of that, which you're going to see in a minute, but our values are still significantly higher than they were in 2020, which quite honestly is great news, but also was part of the problem, which we're going to get into here in a minute. So take a peek at that. Do with it what you will. This is year over year. I found this interesting, and this was published by FHFA. I actually stole this off of the Keeping Current Matters gentleman's, who I've said his name 4 times in the last 20 minutes, and I forgot it again, but anyway, Keeping Current Matters. So this is the chart from year over year, first quarter 2022 to first quarter 2023. Everything in blue represents property values that have increased quarter over quarter. I didn't realize this, to be honest with you. I mean, generally, I'm a Southern California guy. I'd like to think I'm keeping an eye on what's going on in the country. But I was a little bit surprised to see how blue everything was, which basically blue means property values are higher in those areas than they were a year ago, okay? Well, wait a minute. What about the West Coast? I guess I don't know if Utah and Colorado consider themselves West Coast, but for our purposes, they are. Well, these are negative numbers, but they're pretty darn small. California as a state, less than 3% pullback in property values, first quarter 2022 to first quarter 2023. So, and even, you know, Utah's 4.4, Colorado 1, but they're small numbers. They're basically, they're so small, they're almost not even worth mentioning if the fact that everybody wasn't focused on these all the time. I point them out, if for no other reason, to show that they are small numbers. And quite honestly, it's probably not going to be another month or 2 or 3 where whatever property values we've seen pull back in the last 12 months will be erased, and we're going to be back to a break even or maybe even a positive number like the rest of the country. This is just one for you guys to take a look at your own. Again, this is also from FHFA. This goes back 30 years. Property value appreciation across the country over the last 30 years. It's impossible to see the number on your screen, but California's appreciated almost 300%. since 1991. I was talking about Florida earlier, 427% since 2021, since 1991. I got in the business in '87, so this is basically my career. So while I've been in the career in the real estate business, basically puppy dogs and rainbows as it relates to real estate property values across the country. So I want to take a minute and number one, acknowledge and thank and just pay some respect to Bruce Norris. Many of you have seen Bruce speak at the Market Forecast in the past. Bruce did a market timing event. Today, by the way, is June 7th, 2023. 5 days ago, this past Saturday, Bruce did one of his market timing events that he's been doing forever. And 8 hours, I sat in the room with 300 other folks and listened to Bruce go through his stuff. I have mad respect for Bruce. I have not had an opportunity to kind of pull out the 5 or 6 slides that I wanted to. I just didn't have time to do it. But a couple of things I want to talk about. This is the name of his event. His label this time was What's Next? A Lost Decade or 1% Interest Rates. So after 7 hours and 55 minutes, Bruce came to his conclusion that we are not going to be seeing 1% interest rates in the future, which is interesting. And for those of you that have followed Bruce, I don't know if he was trying to play on his prior forecast, but 2 or 3 years, maybe 4 years before we saw sub 3% interest rates, basically interest rates starting with the 2. Bruce did one of these forecasts that basically said we're going to see 2% mortgage rates in the United States. And everybody, myself included, said, what are you doing, Bruce? That's crazy. Nobody's forecasting a 2% mortgage rate. I think at the time rates were probably at 5%. And I called him and talked to him. I've been friends with Bruce for years. And he said, no, that wasn't clickbait. That's not something to get people's attention. I think we're going to see 2% interest rates. And I'm like, wow, I think Bruce might have lost it. Well, guess what we saw? Well, we saw 2% interest rates about, I think it was three and a half years after he forecast that. So with that in mind, when Bruce comes out and says a lost decade or 1% interest rates, I'm thinking, well, shoot, maybe he really thinks we're going to see 1% interest rates. I will tell you, and again, I hate to paraphrase people because I might get it wrong, and I'm assuming Bruce is going to watch this at some point in the future, and I don't want him to be throwing things at the computer screen. But I believe he said, is it possible we're going to have 1% interest rates? Sure. But if we do see 1% interest rates, that is bad, and some very, very bad things have happened within our economy. And basically, that's not what he's calling for. So after his 8 hours of analysis, well, what is he calling for? Well, you only have 2 options here, a lost decade or 1% interest rates. So he's basically saying a lost decade. Now, again, it sounds very dramatic, but you also got to kind of know who Bruce is and what his target audience is. Most of the people that are following Bruce are in the real estate investment world. They're investors, either buying and flipping or buying and holding and looking for residential single-family homes to basically provide an income and a livelihood for them in that marketplace. So just to be clear, when he says a lost decade, he's not saying property values are going to go up, down, left, right, sideways. As a matter of fact, he's not predicting any property values going down. He, in effect, is saying we're just going to be in this period of time, which frankly is going to look very similar to the period of time we've been in for the last year. Very little volume, very little appreciation, not necessarily up or down over time. Yeah, of course, it's going to do one of these things. But for a period of time, we're just going to be in a, shall I use the word stable? A stable marketplace with very low transaction volume and very little price volatility over the long run. Now, if you're an investor, maybe you don't like that. If you're a real estate broker, owner, operator who has an office, I don't like that, because what do I want? I want transaction volume, okay? And in effect, Bruce's analysis is the transaction volume is probably not going to change a whole heck of a lot, but prices are not as well. Now, there is one thing. I'm going to go back a slide to Bruce's thing, and I wish I would have had a little more time to prepare for this, so this is on me. I'll get the information out to you. But Bruce's big thing is affordability. And when the affordability reaches a number in his world, it's 17%, meaning 17, and this is statewide, state of California, affordability reaches 17%, meaning 17% of the people that live in California with a median income can afford to buy the median price house. It's a pretty small number, okay? When it reaches that number, things have to change. And basically what has to change is normally prices need to go down so that affordability number can go back up, or something else has to basically change or break within the market. Well, guess where we are right now? We are at that magical 17% affordability rate in the state of California, which generally would mean things start to break, okay? And I think we kind of have been feeling things breaking here, which for most people who don't look deep at this say, well, what's going to break is property values are going to collapse or property values are going to drop. And we've saw a little bit of that, and everybody gets a little nervous about it. I agree with Bruce, and the reason he feels that's not going to happen is because the transaction volume is so low. And the transaction volume is so low for all of the reasons we've been talking about for months and months and months and months, which basically is we have 60, 70, 80, 90%, depending upon where you're at, people with mortgages below 4%. Big chunk is below 3, another big chunk is between 3 and 3.5, and another big chunk is between 3.5 and 4. It's a huge number of homes in the country, of course in Southern California as well, who just have super attractive mortgages. And because of that, they're just not willing to trade that mortgage for another one. Same thing we've been talking about for months. So Bruce is in effect kind of codifying that argument and saying because of that, we're going to see low transaction volume for an extended period of time, which also, however, will put a base under our property values. I've been leaving our Fed chair up here for a while. We'll see. They're going to be meeting here shortly. I don't know whether they're going to pause or skip or what they're going to do, but at this point, I'm not really sure it matters. The spread between the Fed's rate and the interest rates is pretty high right now. I'm still in the camp with a lot of other people, Barry, Habib, and others that I follow, that, hey, we're gonna settle in and we're gonna start to see mortgage rates drop down a little bit. So let's jump in and do our thing. So for those of you that are here to see what's happening, I love the charts and the graphs. Here we are, Los Angeles County, median price. I'm gonna go a little bit slower than I have in the past because a lot of interesting things going on that I use to plan my business. LA County, median price, 2 years, okay? Again, if you're having a hard time seeing these on your laptop, the entire presentation is available. Just click on the link and you can blow these up, print them, do whatever you want with them. So where are we? This is May of 2021. That is May of this year, 2023, right in the middle. This is our peak. We'll talk about the peak here in a minute. But if you can see this little valley and then you can see things charging back up, once again, for the last 3 months, Los Angeles County has added median price by a little bit, and we'll talk about what that little bit is. So is that a good thing? By the way, all the charts basically look the same. LA County, Riverside County, San Bernardino County, Orange County. Our spotlight city this month is Long Beach. That's home for me. Like I've said in many months before, the charts almost look identical. It is crazy how this market is tracking. Now, I'm assuming we could pull out a little city or someplace somewhere else and says, oh yeah, look how different it is. Well, it's not really different in Southern California. So this is the 2-year chart for LA County. This is the 1-year chart. I think it just kind of isolates that, that breakout a little bit more. And it also shows that we're very, very close to peak. Last month, I started talking a little bit more about peak to trough and where we were with values. So this next chart's going to lay that out a little bit more. This is the peak for LA County. That is April of last year. This is where we've come down, and now you see we've started to go up. Well, what does all that mean? Well, before I tell you what it means, this is year to date for LA County. Last month, I took actually for this entire year, I've had no year-to-date numbers. January to February, January to March, January to April. Said we're not going to do it. Well, here we are in June, which is basically now January to May. I've brought the year-to-date back. Well, does that look like that chart's going up? It is. So from January through May, we've gone up. You'll see the number in a minute, 7.6%. So let's talk about it a little bit. So here we are, current month. Now, by the way, wait a minute, Lance, the 7.6%, that says 6.6. That's the last 12 months. That's May to May. So from May to May, we're down 6.6% in LA County. What's that number? 850 is where we landed in May 31st of 2023. A year ago, we were at 910. 850, 910, that's 6.6% lower for LA County. 2 years ago, we were at 825. It's a 3% increase in LA County total for the last 2 years. Let's call it flat, okay? So we've up, down a little bit. We're basically settled back in. The peak to trough, which was that number that was here, let's go back, that's here, that's peak for LA County. What does that number represent? That represents a 7% decrease in values. But what have we done year to date? We're up 7.6%. So for those of you that are like, oh my gosh, where are we? What's happening? We're going to collapse. We saw the things pull back. We saw things kind of settle down somewhere between November, December, and January in almost every single market. And since then, we've seen values retrench. Good news, right? Yeah, of course it's good news. However, I talked to Chris Thornburg and he says, yeah, but be careful what you ask for, because when the Fed starts to see this and they say, well, wait a minute, we're trying to slow the housing market down. It seems as though we've slowed the housing market down, but apparently not enough, because everybody decided, hey, I think I'm going to go buy a house. Or they decided, I have to buy the house that's available, which is a very, very small segment of transactions that are available. And guess what we've seen? Upward pricing pressure again. So it is a good news, bad news thing. It's kind of hard to sit back and tell somebody, yeah, it's a bad thing that the property values have gone up 7.6%, I guess, unless you're a buyer. But I guess I could have told that buyer, you should have bought in December. If you had bought in December like I told you to, you'd be sitting on 7.6% in appreciation in 3 months, or 4 months. So this is LA County. It took a little more time going through it because, quite honestly, it seems like every month I'm saying the same thing. Riverside, San Bernardino, and Orange look almost identical. The supply and demand number, this is the painful part. I was talking with Adam, and I'm going to be interviewing Chris Leeper here in a little bit. And I was talking to them before we started to shoot today, and we're basically talking about how's the market. And it's kind of a sales thing. I said, how's the market? Oh, the market's fantastic. The market is dependent upon where you're sitting, okay? If I'm a buyer, the market may mean one thing. If I'm a seller, the market may mean another thing. If I'm a real estate agent, it might mean another thing. If you're a broker owner like me, it might mean another thing. It really just depends upon where you're sitting. If you're a buyer, the market's tough only because the inventory is low and you're not happy with the interest rates. However, if you felt that way 3-4 months ago and you didn't buy because of that, well, then guess what? You just lost out. Now the house you are going to buy is 6-7% higher than what it would have been a few months ago. If you're a seller, I don't know what you got to be upset about. My gosh, there's nobody out there selling their house. So if I have a house and I need to sell for whatever reason, get it on the market, price it fairly, and you're still going to have 2, 3, 4, God knows, maybe 10 buyers standing out in front of your house waiting to buy that thing. So that from that perspective, it's good. If you're a real estate agent, from a transaction perspective, transactions are tough. If you're new and you don't have a business plan and this is kind of a hobby for you, well, then guess what? It's a hobby for you and you don't care. Maybe your income's coming from somewhere else. If you're a killer and you have a business plan and you're focused, you're going to be taking market share from other folks, and frankly, you're going to do just fine. If you're a broker owner like me, well, we need some transaction volume, and I don't like it. We'd like to see interest rates come down a little bit. We'd like to see some participation from the sell side of the marketplace, and we would love to get that volume up. What am I talking about on the volume side? These are the listings. We need more listings. These are the days on market chart. Look at that. Or excuse me, the absorption rate, the number of homes currently on the market continues to go down. Those two charts go hand in hand. But what does it mean? Well, what it means is we have 20% fewer listings than we had a year ago. We have 24% fewer listings than we had 2 years ago. Open escrows, 13% fewer open escrows than a year ago, and 30% fewer open escrows than 2 years ago. That's why people like me, who have to basically run a real estate office, are sitting back and say, oh gosh, we need some more transactions. But all that means is work the business plan, go out and capture more market share, and do what I've been doing for 35 years, is constantly adjust these and know those numbers. So anyway, a little bit for everything. I go through that because all 4 of those groups of people are the audience that I think I'm trying to attract here on watching these videos. So what's going on with Riverside County? Looks like LA County, doesn't it? Sure does. That's a 2-year chart. That's the 12-month chart. Again, almost that exact same trend, almost the exact same peak, almost the exact same landing on where we are with value-wise. Peak to current. Peak was, looks like June of last year. That's where we are. Does it look like we're almost back to the June of last year in Riverside County? It looks like that because we almost are. That's a 3% differential, and we'll talk about the numbers here in a minute. Does that look like LA County? It sure does. That's January. That's today. Is that an upward trajectory? Yeah, and it's almost identical, about a 7.5% increase from January to May in Riverside County. Again, you know, I guess the only reason I wouldn't like that is because of what Chris Thornburg told me, and he says, hey, we don't want the market to be this hot. We want the Fed to calm down. We want inflation to calm down. And here we are, you know, well, when you don't have an inventory, that's what it is. So where are we? The median price in the last 12 months in Riverside County is down 2.2%. So crashers, and you know who I'm talking to, oh, the world's ending, the market's going to fall apart. Well, in the last 12 months, we're down 2.2%, which, by the way, you might as well just say flat. If it was up 2.2 or down 2.2, it's irrelevant. That is a flat marketplace, okay? A year ago, we were at 610. 2 years ago, we were at 535. That's 11% higher. So if we just took the last 2 years and we just closed our eyes and we didn't participate in any of it, and we said it's May of 2021, what's property values going to look like in Riverside County in May of 2023? And someone had said they're going to be up 11.6% 24 months from now. We all would say, yay, it's fantastic. That's actually even a little bit higher than what most of us would like to see, 4 or 5% appreciation. I'm just talking residential people. I'm not talking people buying houses strictly on investment or speculation or trying to flip. I'm just saying your average house in your average neighborhood, if it goes up 3, 4, 5% a year, generally we consider that healthy. That would be healthy. It doesn't feel healthy because we've been living the last 2 years with all the drama and all the nonsense and all the speculation, which I guess I got to contribute or takes responsibility for some of it. So here we are from peak to current, down 3%, but year to date we're up 7.5%, almost identical to LA. Supply and demand in Riverside County, oh my gosh, again, the transaction volume is down. They're all down. So by the way, when I say transaction volume, listing volume, red bars, the transaction volumes on the bottom, they're down. I mean, it is what it is. So month supply of inventory looks just like LA County. We started to see a little bit. This was back when we were kind of like that, at that kind of that peak time, September, October, November, things were kind of a little uglier. But nobody's selling their house. The buyer demand is still there, guys. The buyer demand is still there. So if you're thinking about selling and you don't know what's going on, price your property properly, get it on the market with a professional, Coldwell Banker Town & Country, and you're going to probably have 1, 2, 3, maybe 5 offers, 1, 2, 3 days, God forbid 30 days. Yeah, it could take 30 days. I don't know. We just did our sales meeting in our Covina office yesterday at 11 properties that were basically featured in our weekly sales meeting. I believe 6 or 7 of them were already active and pending within 0 to 4 days. Okay, so if you were one of those sellers, you sold your market basically immediately, which is in effect what this chart says. But again, 24.5% fewer houses for sale this year than last, 10% fewer houses for sale from 24 months ago. The pendings are down. Again, this is the part that I hate. 1,655 houses were in escrow. It's 11% fewer than a year ago, 25% fewer than 2 years ago. Ugh, I need more houses. We just need more volume. Where are we with San Bernardino? I'm going to go a little bit quicker. You guys can take a look at the charts are almost identical. I will point something out in San Bernardino for those of you that are like, oh, Lance, you're using median price. Why do you use median price? Median price sucks. Calm down, okay? We always talk about median price. I've been using median price forever. Yes, there's some challenges with median price, but we're looking for trends. I'm not going to get hung up on 1 month. 1 month does not make a market, okay? I'm looking for a trend, and the trend is the same, okay? However, for you median price critics, well, we had our little anomaly last month in San Bernardino County. Well, it seems to have corrected itself and it's balanced itself out. That anomaly, by the way, if you couldn't tell what I was looking at, San Bernardino County pulled back a little bit in the month of April. Didn't kind of sort of make sense. That could have been a median price anomaly. Well, guess what? We're back in May. It's back up. The world has been restored, and trust me, median price is fine. If you have any concerns with it, call me. Here's peak in San Bernardino, which was May of last year, which just so happens to be May of this year, so we're year over year. And guess what? There is our year to date, January to May number. It is identical to San Bernardino, excuse me, identical to Riverside County, 7.5% increase year to date. So here we are. $500,000 median price, 4.7% less than 12 months ago. Does this number look familiar? Almost identical to Riverside County. The 24-month, 2-year chart, San Bernardino County is up 11.1%. Using that same scenario I just gave you, you went to sleep, someone said where the value is going to be 2 years from now. If someone said 11%, I'd say, well, it seems like a pretty healthy market. That's exactly where we landed. Peak to current, down 5%, 4.7, but year to date up 7.5. So again, you crashers, I don't know what to tell you. Supply and demand, San Bernardino County, it's identical. I'm just going to blow through it. It looks exactly the same as LA and Riverside. Where are we? 23% fewer listings from a year ago, 18.9% fewer from 2 years ago. Again, this is Lance. This is broker owner, Coldwell Banker Town and Country. Got his little, my little sob story out. 15% fewer transactions than a year ago, 32% fewer transactions than 2 years ago. It is what it is. Just get used to it. Adjust your business plan. If this hits you where it hits me, adjust your business plan. Orange County. So I made a commitment 2 months ago, 3 months ago. We're going to do Orange County every single month. So here we are. I'll just isolate the next month. Orange County, similar to San Bernardino County, we saw a pullback. I was a little wondering, I'm like, I wonder if that's going to be something we're going to see in Orange County if for no other reason we're looking at median property values at 1.2 million, give or take. So I'm thinking, maybe the higher price market is going to suffer a little bit, and us Inland Empire folks are going to be like, oh, we're okay because we're kind of the entry level value. Well, if that was true, Orange County said, nope, we're not going to suffer, we're going to do just fine. And they basically backfilled all of the loss that we saw last month, and they added, and then they went up again. So Orange County looks pretty healthy, except for transaction volume. Here's the peak in Orange County. Year to date, Orange County is in better than all the other counties. 8.1% increase from January to May. So it is what it is. So where are we? In the last 12 months, Orange County's lost 2%. I think it was 2 or 3 or 4 months ago. Actually, I think it was November or December. You can go back and watch the snapshot. I was talking to a buddy who's out there. He's, oh my God, we've lost 25% or 12% or 20%. We're crushing it in a bad way. We're getting crushed in Orange County. Like, yeah, that's rough. Okay, well, something has changed. They pretty much backfilled it. They're at a 2% loss over the last 12 months, almost, again, flat, no change. That, by the way, that's a 1.25 million price compared to 1.275 million 12 months ago, compared to 1.088 2 years ago, but that's still 14.8% higher. So basically, Orange County, 15% higher in median price than it was 2 years ago. Kind of hard to complain too much about that. Peak was down by 3.8, but year to date up by 8. So again, Orange County's doing just fine. However, they have the exact same problem that we all have, fewer transactions. But what do you mean a problem, Lance? One person's problem is another person's opportunity. If I'm a seller in Orange County and I'm not worried about giving up a 3% interest rate, guess what? You're going to do just fine, okay? Frankly, if you were a buyer in Orange County, you said, I don't want to buy a house. Well, you probably should have, because if you had bought it in January, you could have got it for 8% less. Don't know what to tell you, all right? Again, if you're a real estate agent or broker, just get out there, bust ass, work your plan, and take market share. That's really all you can hope for. Month supply in Orange County, again, it looks almost exactly the same. Again, the tough part, listings down 28% from 2 years ago, 31%. Sales down 15% from a year ago, and here we are again, 40% fewer sales. So, okay, my spotlight city is Long Beach. I double checked these numbers, so any of my Long Beach brokers out there, do me a favor, take a peek at this. If I've made a mistake, then let me know and we'll get it fixed immediately. Having said that, I was a little surprised. Long Beach is home for me. So median price in Long Beach, price is a little choppier than I would have expected. We did see a little bit of a pullback in the last 2 months. I don't know. We'll see what that looks like. That's our peak to date. But even though we saw a little bit of a pullback, we're still up year to date in Orange County. It looks like they had a nice little run in January, February, March, a little softer at April and May, but it's still almost 4% higher than it was at the beginning of the year. $860,000 median price in the city of Long Beach, 8.5% lower than it was a year ago. Flat from 2 years ago, it's 1.2%. So same story, if I'm in Long Beach, close my eyes and wake up 2 years later and someone said, property values are 1.2% higher from May of 2021 to May of 2023, I probably would have said, that seems like a pretty flat, boring real estate market. But hey, every now and then, guess what? We have flat, boring real estate markets. But it's a positive number, no big deal. I did not do peak to current for Long Beach. I just didn't do it. But year to date, 3.9% increase. And this is Long Beach is huge, by the way. It's a very, very big city. Supply and demand for Long Beach, exact same trend. Listing are down. This is the part that really, really surprised me. You guys can look at these on your own. Again, absorption rate just low. This is the part that really surprised me. And by the way, you Long Beach brokers, check this out. If I'm wrong, I'll come back and we'll get it corrected. 300 houses for sale in the city of Long Beach? Are you kidding me? That's ridiculous. I mean, Long Beach is one of the largest cities represented in CRMLS. Super small number. 25% fewer than a year ago, 33% from 2 years ago. This number is like ridiculously low. 131 properties pending in the entire city of Long Beach. There's got to be, I bet there's 10,000 agents. Well, maybe that's too many. I bet there's 3,000, 4,000 agents that work in the city of Long Beach alone. That's rough. That's rough. Anyway, the numbers on the pending side are just really, really bad. So where are we with interest rates? Well, I don't know. We're up or down. We're all around. The Fed's going to meet and come out again. I think they're going to pause. We're going to see. This is from Optimal Blue, 6 3/4 on basically a 30-year conforming. Are you going to get that rate? I have no idea. Call me. I'll connect you with my preferred lending partner. You might do a little bit better. You might do a little bit worse, depending upon a gazillion factors. This is just an index that's thrown across the country. Year over year, though, we were at about 5.5. This is another thing I do find interesting. Guys, we've been talking about this interest rate explosion and how painful it's been, and it has exploded and it has been painful. But the reality is, if you don't go back to when we were at 3 and you just go back to where we were a year ago, well, a year ago we were 5.5%. So under a normal real estate market, if someone said, hey, interest rates are going to go up 1% in the next 12 months, under a normal market, okay, whatever. We're just all excited and exercised because they went from 3% to 7% and then back and forth. But we're starting to kind of settle in. And quite honestly, the buyers that are in the marketplace right now, they're settling in. Like, hey, I want to buy a house. This is what I need for my family. If I have to pay an interest rate that starts with a 6, then I'm going to pay an interest rate that starts with a 6. So we've seen a little bit of choppiness. Again, the smart money, in my opinion, is rates will go down. If you're a buyer, don't wait. Buy the house you want now, refi it out 6 months now, for a year from now if the rates go down. And if they don't go down, hey, you got your rate locked in, you're good to go. This is the rate if you just jump on Google, which is most of what you would do if you're just your average consumer and say, let me go to Google and type this in. This was as of yesterday, $500,000 loan with the 750 FICO. Why is it higher? It's higher. I don't know. This is the deal, though. Don't go to Google to find out what your rate's going to be. Don't go to Google to get a loan. Don't go to Google and do an online loan application. If you're buying a house and you're getting a loan, call me. Let me connect you with one of my pros and we'll get you going. Okay, we are almost done. I've been trying to do this for the last 2 years. I've been promising we're going to start doing monthly interviews. We're finally going to be on track. Last month we did a secondary interview with Chris Thornburg, and this month we've got Chris Leeper, one of the top agents in the Inland Empire, one of the top teams in the Inland Empire, good friend of mine. We're going to take a pause after this and we're going to bring Chris up. We're going to shoot Chris's interview. So if you're interested in seeing that, it'll kind of be linked to the market snapshot. So Chris is coming up next. So for now, thank you for coming to our June snapshot. We will see you again next month, and thanks for listening.